Hey everyone. Welcome to this elite subscriber live stream. The topic for today will be options. We will talk about options in general, what they are, and I will show you examples of what not to do, how I use them, and basically everything you need to know in the retail trading environment to express your views in the markets based on targets or any other signals using option. So yeah, let's see if we have people watching. Okay, yeah. So I will share my screen. Yeah, so now you should see this Excel spreadsheet and this video, this presentation will be different. We will not be talking about Greeks or other stuff that is actually not needed for people who just want to express their views in the financial markets. And we will start from the most important principle in the options, which is the put call parity. Put call parity is basically the only thing that you need to understand in order to be able to create any structure and any payoff, any risk profile in the markets. So I will not explain what is a put and what is a call. I'm sure that you already know that. It's simply a right, but not the obligation to buy or sell underlying at a predefined strike price before the expiration date. In the case of American options, it's at or before. In the case of European options, which are index options, you can exercise it at the expiration date. But put call parity is very important principle in the options, and basically it means that put is a call and call is a put, and that you can structure any other payoff using either stock, put, or a call. And we will start with a very simple example. So here we have a payoff diagram, which is a linear diagram of a long stock position. So here we are just long 100 shares at $50, and of course our payoff is linear. It means that if a stock price goes up, we make money. If a stock price goes down, we lose money. So this is pretty straightforward. Now the payoff diagram of a short stock. So instead of buying 100 shares, we will short 100 shares, and everything is the same, just in reverse. So of course, underlying if the price of underlying goes down, you make money. If the price of underlying goes up, you lose money. The problem, of course, is that your risk is undefined. You have unlimited risk because stocks can double, triple, quadruple, and you are not protected at all. Now, where the put call parity comes in play, that as I said, we have three bricks in the market. So three bricks, you can think of them as underlying call and put. And as I said, we can structure any payoff that we want using one or the other. So, for example, we already learned that the payoff diagram of a being long stock is linear, and everything is very straightforward here. So now, can we get this exact payoff diagram without using any shares at all? And the answer is, of course, we can. So let's create what's called a synthetic long position. And the synthetic long position is basically just buying a call and selling a put. And if we do that, we will see. what happens. So we buy a call, let's say same 50 strike. Let's say for that call we pay, I don't know, $2, and we buy one call. Now at the same time we will we will sell a put, which is strike 50. So let's create, let's say that we also have $2 in premium, and let's say that we will short that. So wait, I need to delete this. Mm, what's wrong with that? Yeah, strike 50, call put, premium is $2. We are long and short. Sorry for that. I why it's not working? It should calculate everything. Yes. So okay, cool. Okay, let's go to TradingView. I don't know. Yeah, so let's buy a call position. Let's say January 16 in SPY. We will buy call position at this strike, and we will sell a put position also at this strike. Yeah, and TradingView will be better. I don't know why my spreadsheet doesn't work in this case, but basically what we got here, we got here the exact same payoff that we had with being a long stock. So as you can see, the payoff is absolutely linear. If underlying goes up, we make money. If underlying goes down, we lose money. Uh, so this is called a synthetic long position. Of course, you will not be using a synthetic long position, but it's a great example of these bricks that we talked about and the put call parity that basically you can create any payoff, any structure in the markets without using underlyings. And now if we just reverse everything, and instead of us being long a call and short a put, if instead of that we buy a put and short a call also at the same expiration price, you will see that we have the exact same payoff as being a short stock. So now we just created what's called a synthetic short position. So when you start thinking about options and underlying just like Lego bricks or simple bricks in the markets, you start understanding and structuring any payoffs that you want, and you will be able to achieve any risk profile you want without using a lot of capital, without freezing a lot of capital in your account, and also you will be able to limit your risk and create any reward that you want. So these were the most simple examples of a payoff of being long or short a stock, and how to create the exact same thing using options. People in the institutional world mostly, but basically the only viable reason to do that is if you don't want to sell a stock that you uh, own, because for tax reasons or reporting reasons. So sometimes this is a very useful strategy for them. But in our scenario, we will not use that. And in the end of the video, I will show you another way how to delay your taxes for a year, absolutely legally and without no risks at all. But this will be not it. Now, what is the problem with all this payoff is, of course, that our risk is undefined. We have unlimited risk, and if a position goes against us, especially if a stock gaps up or so on, we can't do anything about it. And of course, this is not the way how I understand trading and the risk management. So now, where the options come in play. So now, how if we simply buy a call option instead of buying a stock, which is again, we will not do that mostly. But basically, in this case, we bought a put. I don't know why we did that. Okay. So, call option. Of course, you have unlimited upside if underlying rallies and continues to go up. You have technically unlimited upside. So, and your risk is the premium that you paid for a call. So, of course, in this scenario, if you paid $10, like TradingView shows us now, your risk is $10 and you can't lose anything else. Of course, there is one problem with being long or long calls or puts outright without creating other structures is that even if if you are right, but underlying doesn't move a lot. Let's say you buy a call of 676 strike, but you paid $10 for it. It needs underlying needs to go $10 for you just to end up break even at the expiration. So of course this is another problem that we will tackle and that we will talk about. But you need to start looking at these payoff diagrams and understanding what is going on. So now, if instead of that we buy a put, same put, but instead of buying a call, we will buy a put. Of course, everything is the same, but in reverse. So now, if underlying is falling, you technically have unlimited upside. Of course, stock can only go to zero, but again, your risk is exactly same as with being long calls. Basically, you risk the premium you pay, and that's the only risk you will experience. And this way, you don't care about gaps, about sharp price movements against you. So basically, you just manage your risk in this way. Now we will start with the fun stuff and what not to do. And also, we will talk about one popular strategy that a lot of YouTubers talk, and they say that it's very good for your portfolios. It generates income and other stuff. But before we do that, we will talk about what to never do, and it's selling options outright. So we will start with shorting a call. What happens if we simply sell a call option instead of buying it or instead of using any other viable strategy? So from this payoff diagram, you see that basically your maximum reward is the premium you received for that call. And that's the best case scenario. That's the maximum profit that you can get is that premium that you received while selling a call option. But of course, uh, with selling options, especially selling call options, your risk is unlimited. So basically, you are agreeing to take $6 to have unlimited risk, and sooner or later to blow your trading accounts and lose all your money that you haven't. And sometimes, in rare cases, you can even end up in debt to your broker. So, of course, uh, this is what we will never do. So, this is a short call. Now, we will talk about short put because a lot of people think that it's actually a better deal. Uh, New position. Okay, so we will sell a put at 676. Yes. So basically, TradingView can't find the price. That's why it doesn't show me the payoff. So now let's see if we get any price, or maybe we can go to futures markets, because in the futures markets we will get that. Yes. Okay. So TradingView found a price because now the market is obviously closed, so we need to use what we have. But same scenario, your maximum risk is your maximum profit is the premium you received, in this case $8. But of course, if the underlying goes down, your risk is again unlimited, and you can lose your entire account just for a small premium that you receive. A lot of people say that it's a great way to buy a stock at the price you want uh, if the underlying goes to that price. And if not, they say, hey, at least you have this, you collected this premium. So a lot of people talk about it like it's some limit order, but you get paid to get this limit order. Well, maybe now you want to buy a stock and you think, oh, if this stock goes down to this price, I will be happy to buy it. But usually when that happens, especially if it happens fast, well, most likely something happened. Most likely there are some new news, or maybe bad earnings or something, tariffs, whatever, and maybe now you don't want to buy that stock anymore. And of course, you will be assigned, and you will have to either take a loss, so buy back the put option at a loss, or to buy that stock. And very often you will not want to do that, because if we get sharp movement, of course, something happened and information changed. Uh, so now there is this very popular strategy called the wheel strategy, where people are selling puts, collecting premium. They get assigned a stock, and then they do what's called a covered call position. So then they sell calls against that stock, and after some time, that stock gets called out, and yeah, and they say that it's an income. So first of all, it's not an income, same as the dividends, but it's way worse, because first of all, you get taxed on every single premium that you received, and second of all, you still have unlimited upside. So now, why I am talking about covered calls while staring at the payoff diagram of being short a put? Because the payoff of covered call is exactly the same. It's exactly the same. So basically, people who do wheel strategies, they are always short put options. They are always short put options. Of course, a lot of people don't understand that, because once you get assigned a stock and you sell a call, so let's say you get assigned a stock for $100, you say you sell a call for 105 strike, you receive couple dollars of premium. That's it. Again, your maximum profit on that position is, of course, the difference between your underlying price and the premium you received, and if any differences between strike prices. So in this case, 100, if stock goes to 105, you have this call sold, you will make $5 plus whatever the premium you receive. And people say, oh, it's good. And yeah, so let's say it's $7, just for the case of example. Let's say you made $7, you still have all this downside. So of course, people say that it's a way to limit risk, which is not the case, because the stock can still go to zero, or go down 50%, 30%, 70%, whatever. So your risk is reduced only by the tiny amount of the premiums you receive. So basically, what these people are doing, and sooner or later it always ends bad. They understand that, well, it's not an income. Basically, you were long a stock, and what happened is, of course, that some months you are happy because you are collecting these premiums, and then when the sharp move happens, they give all the collected premiums back and more, and sell their positions at a loss. So this is why covered calls are never also an option if you want to grow your trading account and manage risk. So I hope I made at least one thing clear, because I know that there are questions and discussions on Twitter, especially about income, how to use options for income, and what options are not. It's not a tool for you to just collect some risk-free income, or some no-brainer strategies where you retire, you buy some ETF, and there are these ETFs now that are always falling in price, and some people that are selling options, and some people say, "Oh, price doesn't matter. You need to look at total return." Well, okay, I looked at the total return. So one thing that you shouldn't do, especially if you are thinking about retirement, is buy these option ETFs that pay distributions every single month, because the only people who will make money from that is, of course, the companies who issued these ETFs. So these are the basics. We learned how to create a long stock payoff, short stock payoff, and using options, about the fact that all these bricks are equal, and you can create any payoff from any combination. And of course, we talked about why selling options is not an option, and why covered call strategy is also not a viable option for our portfolios at all. So now we will start creating payoff diagrams that actually make sense. And in this case, we will use MFR targets to create strikes. But first, I will show you the favorite strategy of mine, and which makes sense from risk and reward perspective, and from allocated capital perspective, which is a vertical spread. Vertical spreads can be done with calls. It can be done with puts, and this is one of the most common ways how I execute my positions when it comes to buying some stock at the target or something. So, what is a vertical spread? For those who don't know, we will start doing combinations, like we did with the synthetic example. We will start doing combinations. It means instead of using one option, we will use multiple options to create a combination with a payoff profile that we like. And the first bullish example will be, of course, a vertical call spread or bull call spread. There are many examples, but let's say we think that currently SPY is trading at 676. Let's say we think that in the next month or two, it should go to 685. So, of course, what can you do with that? Of course, you can buy a call. A lot of people make this big mistake. They buy very deep out of the money calls because they are cheap. But actually, there is a reason why it's cheap, and for you to make money, your chances of making money are very low. If you buy at the money call option, you would say, okay, so it's more expensive, but at least it's at the money. And what will happen again? You will pay, for example, let's say you will pay $10 for it. So, and remember, your target is 685. So you think that the stock will go to $685. Now, what happens if you are right? You bought this call option, you let's say 676, just for example. You paid $10 for it. Your break even is at 686, so you can be right stock goes to 685 and you will not make any money. So now the beauty of vertical spreads. Let's say that we simply buy a call option at this price, 676, whatever. We buy this call option and then we sell the option at our target. That's all it is. Same expiration, same type. We just sell this option. And now what we have, of course, these are not the real prices. They are close to real, but they are closing prices because markets are closed now. Usually, you will get a better risk reward when you see now, but look at your break-even price because your break-even price is now closer to 681, actually, just because you sold your call at the target. So basically, what happens now? If you are wrong and the stock stays where it is, or let's say it goes down, again, the maximum loss that you can get is, of course, the premium that you paid for this position. In this case, it's 457, but I will show you practical examples with MFR targets in live markets. Yeah, the live markets most likely will have to do a stream when the markets are actually open. But let's say you are right and your target is 685. Even if a stock doesn't go to 685, but let's say it goes to 682, 683, and then stops, you can still close that position for a profit because everything above your break even will start generating money. And of course, you are limiting your upside, but there is a reason why we do that. Of course, capital efficiency and usually stocks don't go to eternity. We need to have targets and we need to know where we will be happy to sell. So the maximum profit in this case is, of course, if stock goes to 685. If stock goes even higher, you still keep your maximum profit, but you don't make any additional money anymore. So this is a vertical spread, and we just reduced the price of our call option basically in half, and we reduced our break-even price basically in half compared to just being a long a call option, for an example. So this is a vertical call spread, and we will only talk about two strategies that are useful for targets before we go to examples. So, of course, vertical spread is one strategy, and put vertical spread is the same strategy. It's just using puts. And actually, I think that this is the only viable way to take short positions because I am always talking that I think that 99% of people should not be involved in shorting anyway because stocks on average they go up and these bounces can be brutal and shorting stocks is a very risky endeavor. But same as with call vertical spreads, with put vertical spreads, we have this safety. So instead of buying a call and selling a call, now let's think a little bit in reverse. SPY is trading at 676. We think that SPY will go to 665 just because we think that this bull market is over. We will get a correction, especially in the beginning of the year. New capital will come, and we are bearish on the market. So what we can do, we can buy a put here, which is 676, and our target is 665. Our target is 665. So what we do here, we create this position. Yeah, now the payoff looks quite real actually. So okay, now what happens again? If you are wrong, if price doesn't go down or even goes up, you will your maximum loss is what you paid for this option. And in this case, it would be $334 for this combination, I meant, not for this option. But now, if you're right, of course, your break-even price is basically okay. We paid like four, yeah, yeah. So still 672. We will already be happy with our position. So, and then if you are right and it continues to go, of course, our maximum profit is if stock goes to 665, which is our target. And if it continues to fall, you don't make any additional money, but this way you created this nice risk reward profile without buying any underlying and without freezing a lot of capital. I always talk about capital efficiency, and of course, I need to make clear what do I mean by that and what is the problem. And a lot of people don't think that it is a problem, but actually it is, especially if you are not investing, but you are actively managing your portfolio. So let's say you are holding positions for weeks, months, but not decades. For you to buy stock, you would either need to have a margin account and then pay interest on margin. But even if you do so, no one will give you more like 2 to 1 or 4 to 1 overnight. So now, how much capital you needed to get exposure to 100 buy shares at $606? A lot. Even with 2 to 1 leverage, that would be 38 grand. You need to literally deposit that money and freeze it. And what is the payoff? What is the payoff? If you are right and the stock goes to $665, of course, um, then your returns are also linear. Of course, now you will say, "Hey, I will make more because I have 100 shares here." But yeah, we can use multiple vertical spreads, so it's actually the same, but without employing a lot of capital. And our capital can collect interest in some money markets funds, or be used to fund our other positions, or be in silver, gold, or any other asset that you like. So, so what happens here? I think it's very clear. I think it's very clear that now we have this position, and our risk is limited. Our reward is also limited, but we have a positive risk reward profile, and of course we only needed to employ a very small amount of capital in order to do that. So this is in my opinion, the most useful options trading strategy for retail traders. And first of all, it's quite easy to understand, and it's very easy to define a risk and to create risk profile, and to not be worried when the price comes to your target. Oh, that now it's chopping around that target. Maybe it closed above that target, but next day it opened slightly below. And then with stocks, you would think, do I need to close my position or not with this vertical spread? All these wiggles in the market doesn't matter. Uh, of course, there are risk management rules that I use, and when I say that max loss is in this case 334, I would almost never wait for that to happen. My rule for vertical spreads is my stop is 50% of the uh, premium. So if I paid, think of it this way: if I paid 334, half of that would be 170, let's say. And if that spread loses 170, so let's say now it's trading at 170. I paid 340, now it's trading at 170. I would take my stop. One thing to note, that in options markets, it's better to not place stop orders with your broker, because market makers because especially these combinations, the price of them is being of course, affected by the price changes in single options that you have and so on. And market makers also, they really like. So it's better to get out manually when you see that this position, let's say, is not working at 50%, you just close it. Profit, also, I rarely wait for maximum profit unless, of course, it happens quickly. But in this case, if your risk reward is, let's say, 2 to 1, at 80% of maximum profit, I would get out of that position. So if maximum profit is 760 or so, if you make like $600 from this position from one vertical spread, this is where I would close that position because, of course, especially if we still have plenty of time to the expiration. So it just doesn't make any sense because we have risk that the market will come back and our maximum potential is limited anyway. So 80% of maximum profit is a good spot, and it doesn't make any sense to wait for maximum, especially knowing the fact that the only time when you will get that maximum is actually very close to expiration. And if you can already book most of the potential profits, it makes sense to do. So this is the strategy that I wanted, the first strategy that I wanted to talk about. And then the next strategy that I wanted to talk about today is a uh, diagonal spread. So it's a bit more advanced, but it's very useful because this way you have four different scenarios of how to manage this trade. And of course, it's one of the ways how to get a uh, potentially unlimited upside for cheaper. So how to actually buy a call or a put in this case, but for less money. So of course, there's no free lunch, so we will talk about it. But diagonal spread is a type of a calendar spread, and for those who are not familiar, when we did a vertical spread, we used the same expiration. So whatever that expiration was in our examples, but both options were expiring on the same day. Calendar spread is different from vertical spreads because we will be buying and selling options that have a different expiration. So first, I will show you what not to do, and I don't think that it's useful to anyone in the retail trading space. But what not to do is to not do a regular calendar spread, because the regular calendar spread would be that you are buying and selling option in different expiration cycles, but with the same strike price. So just let's create an example. So let's say we are selling this put at on a January 16 expiration, and let's say we are buying this put on February 20th expiration. So of course it doesn't have six strikes, so we will just change that because our examples need to be good. Okay, so now why to not do that? And there is a reason because also people think that this way they can buy a longer term put for cheaper, but actually this play is a 100% volatility play. It's not a directional bet. It's a bet that volatility will increase. That's the only bet that this strategy is useful for. And retail traders should manage their money directionally, even if they want to be market neutral. But when it comes to underlying assets, single assets, you are either bullish or bearish that asset. So this looks crazy, and it is crazy. And good news that, in my opinion, you would never need to to do that, because the only way for you to make money actually is if implied volatility increases. But also there's a catch that if it increases too much, you can lose your money again. So I just wanted to clear things up and explain the difference between calendar and diagonal. So I showed the calendar, and of course, calendar was just uh, same strike price, same option type, different expiration. Now, diagonal is different from calendar because we will use not only different expirations, but we will use different strikes. So now, how to play for example, bear market. You think that first quarter of 2026 will be crazy. Yes, will go down 20%, 30%, whatever. These are all hypothetical examples because, of course, we always need some actual opinions for us to show any example. But let's say you will think that SPY will go to 580 or S&P 500, so 5,800. So now, and you think that it will happen in the first quarter. So now, of course, buying an option which expires, let's say, March 20, put option at the money would be quite expensive. At least based on closing prices, you would have to pay like $2,000 for one put option. Of course, you don't want to do that. Because 2000, even if SPY goes down 3%, you will still lose money. Of course, our targets are way higher in this hypothetical example, but what can we do? So first, we will buy, of course, this option. We will buy this option just okay at the money put. At the money put, we will come back to January or February. We will talk about exact rules later, but we will come back to the previous cycle, and we will sell a put option which is actually has a lower strike price, and I will explain why it is important and why this way you will make sure that you will not have unexpected losses. But what happened now? And don't look at this payoff diagrams because the calendars and diagonals, of course, they are showing the diagram at the expiration. But basically, let's take a look. Yeah, yes, okay. Again, it's because market is closed. I need to make sure that all the examples are okay. Will they? Because this is a put and I don't want to be long a fund. No position and yeah, so and we are buying this put. Yes, now we are correct. But don't look at this diagram. Basically, what just happened and why we have four scenarios. So you just reduce the price of this position basically in half. Let's say you will pay $1,000. Now there are four scenarios. So scenario number one, of course, is very easy to explain and understand. Scenario number one, well, market goes up. You were bearish, so nothing happens. So of course, this put option that you sold for January will expire worthless. And if nothing happens till March, of course, your puts will also lose money. So in this case, again, 50% rule is what I use, and at 50% loss, I will close. But now let's talk about good scenario. So first scenario, market is not falling on January 16, and S&P closes above the strike of the put that you sold for January 16 expiration. Your put expired. You keep your 800 premium, but now you have this 675 put to keep, and you can make a decision that you are keeping this put. And now basically you have that same option that you wanted to buy, but instead of paying 2,000, this strategy gave you 800 back, and you keep this 800. So you just bought it for 1,100, let's say. And now, of course, if market collapses as you expected, and before March expiration, of course, your profits will become uncapped. You can make, I mean, if ES go to 5,000, you will make a lot of money. So that's why I said to not look at these payoff diagrams, because the payoff diagrams shows a combination itself. But this way, one thing that is very important to understand, that the diagonals in the case of puts, we are selling the lower strike, which will expire in January. Because if we would do simple calendar, then you don't know what implied volatility would be. And here we don't care about implied volatility at all. Because if on January 16 market is below 670, why it's not a risk and everything is fine? Because this strike is 675, and this put option will be at least $5 plus whatever extrinsic value it has in profit. So you will just close your entire position. You will keep profits, whatever you can, based on this March position. It will not be crazy, but you still can make money, but you are safe. If these would be the same strikes, you don't know. Of course, a lot of people think, oh yeah, of course, March option will be more expensive because it has more time to expiration. Well, if big drop happens and then you will get volatility crash, sometimes it's not the case. That's why I said to not do that. Yeah. So, and of course, why I said we have multiple scenarios. So if this happens, okay, you made some. If market was just going up and the crash never happened, you just close your position at 50% loss. If you decide to keep March, then you have unlimited also profit potential, but you also have options, because maybe in February, when 1 month remains for your position, maybe you will create a vertical spread using this option that you already have. So the last option, which is, I rarely do that. Usually it doesn't make sense from profit potential, unless, of course, market moved you a lot already. But you already have a 675 put. You can then sell another put and create vertical in the same way that I explained. So this is puts. Same for bulls, and of course I do that for stocks bullish most of the time, because I when it comes to equities, I just don't like being short them. For that, I trade futures, because futures are created to be traded both ways. But same with calls. So let's say our scenario is that S&P will go to 7,500. You think, all these bears are talking nonsense, market will rally. So what you do now, of course, you can buy a call, and this is a problem. So you can buy a call, but 680, for example, 680 all will cost more than 2 grand for you. So what we do, and again, I will stress that we sell a call, but in the case of a call diagonal, we will sell a call which is higher. So let's say 685, and decent. We just got 500 back, and of course, I forgot to mention another scenario. Here we are selling January. Instead of January, we can do February, and I wanted to, because this way you just reduced your cost even more significantly. But why I usually do 1 month first, because this gives us all these scenarios where, for example, if we sold this call, sold this call and it expired worthless, we kept money. Uh, we are keeping our March call, but then we can sell February and collect some money again. So, and then these premiums make the cost basis of the strategy cheaper and cheaper and cheaper. Of course, if the strategy is working. So, because January, for example, would give you 570 back, and February, for example, would give you more than 1200 back. So, of course, you would say, hey, it's a no-brainer. But if we do it now in December, we don't know what market will do in February. Maybe market will collapse literally New Year, or it's a call spread example. Maybe market rallies, just New Year starts and it rallies, and then you say, oh, if I had this January, I could make $20,000, and now this option that I sold for February is basically capping all my. So I do it one at a time. But basically, why I said that this strategy is very useful, but you need to spend time to understand, is because this way you have multiple options and multiple scenarios in the market that can play in your favor. And some options are with limited upside, but if you end up keeping that March option, either put or call, then you have unlimited potential. So, quick recap: what I wanted to show, like I said, it's different because I think that's what retail traders need to understand about options. So the options are like bricks in the markets, and not only options. We have three types of bricks. We have underlying, we have call options, and we have put options. And whatever risk profile or payoff we want to have, we can create either with calls or with puts or with underlying and call, underlying and put. For example, this is a too much for this video, but you can create the exact payoff of long put option, for example, just by using a combination of stocks and calls. Of course, you need to know when to buy them, when to sell them. Yeah, but you can create call from puts, you can create puts from calls, you can create stock from options, and you can create any strategy from other remaining bricks. So that's the beauty of this market. And of course, we talked about why selling options is nonsense and why covered call is actually being short a put. So those people who trade covered calls, they are always shorting a put. And of course, if I made an impact, then you will stop buying all these option-based ETFs for your retirement portfolio when my job is done. So now, Rafael, take over from here.
Yes, thank you, Vi. So I actually have a question regarding how to choose the expiration. So, for example, how far away would you select your expiration price, depending on the two strategies you have
Yes,
highlighted?
of course. I'll share my screen again. It's a very good question because um, now is the time to show practical examples. So we will not be looking at options diagrams here. I don't even know what the sticker is, but we will go to SPY just for example. We don't need anything. We just need MFR targets for this example. So we will use MFR targets. So for vertical spreads, usually I'm not thinking about any catalysts, what may happen, things like earnings or so. So it's quite a simple answer that minimum 1 month, but never more than 3 months is the time frame. Usually I buy monthly options, not a weekly options. even though in the names like SPY or others, there is liquidity on any, but basically, usually I buy the ones that are third Friday of the month, so it's monthly options. And also strikes that have more open interest. So in the case of stocks or ETFs, it's strikes that end up with 5 and 0. Basically, these are the ones. But now, example. So example of a vertical spread. So we had this sharp move up in the market, and now imagine if you say, F it, I think it's over, and actually it would make sense because market gave us everything it had to give. Keep in mind that our annual targets were 660. We had a quarterly target at 689, and basically market went there. So I think that it's done for the year, but you want to play for a move down. So what would you do? You would do a put vertical spread. Now, expiration, right? So let's say you would do it now. So it's like December 10th, December 11th. You said, okay, I wanted to do so. You the least amount of time you will give yourself is January monthly expiration. But if you want to be more aggressive and have a wider spread, then maybe you can go all the way to February, but no more than March. So what I mean more aggressive. So first, if you buy 690 put and then you sell a 680, for example, because we have our pivots, we have target, everything matches up. Market basically reached all the targets that it wanted to reach. So 690, 680 spread. I would do it for January, but if you want to do a wider one, so maybe from 690 to quarterly pivot, of course, you will have to allocate a bit more capital, but you can do February easy if you want to do that. But I would do something like this: 690 to 680 January monthly expiration. First of all, the move already happened, so we are all adults here. So don't tomorrow in the morning don't start clicking buttons and creating this spread. But basically, that would be a my play. And why would I do that? I see there is a question about fractal range, so I will address later. Trading plan is about teaching you how to execute at targets. Well, I mean this video, not trading plan itself. So this is so the reason why you open this position could be just because it went back to a quarterly target. We are way above our annual target, and rollover. So rollover will cause multiple volatility. So now I'm not talking about the actual reasons, but I need to give a very good example. And good examples are, of course, that when market is trading close to 690, you think, I think that maybe we will get a dip. So that would be 690 to 680 put spread. Now with diagonals. So diagonals usually the option that I sell. I also think about catalysts.
Wait, Vi. Maybe we need to read the questions out loud because maybe people will not know why you are now switching to diagonals. So Fitzroy asks, how do you use fractal ranges and targets when deciding strikes and expiries when building a diagonal spread? So that's why Vi is switching.
Yeah. Okay. Yeah. So ranges are for timing our positions. It has no impact on prices or strikes. So of course I want to see same the verticals and diagonals was the same case. Of course, at the same time I want to see market being somewhere close to the top of the range, at least a regular term. Let's wait for it to load. Yeah. So in this case we were kind of in the middle of a regular range. So I would want but ranges in this process. Range is a risk profile. Range is a timing mechanism. Does it is market trading within its bounds somewhere close to its projected upside or downside, or is it trading somewhere in the middle? So which is a confirmation tool. Uh, I remember 5 years ago, I was very pissed off when I saw a video of our ranges provider, let's talk like that. And the education was like you buy low of the range and you sell high of the range, and you buy low of the range and you sell high of the range. Well, it's not exactly like that. Range is a risk profile. It gives you conviction whether you want to execute it here or not based on your process. So now I will talk about diagonals, and I will address this question because ranges will not help me to find strikes. Strikes are targets. If I do any options position, it means we are trading in some place that is interesting. Sometimes it can be just a break above a pivot, but uh, but usually it is that we reached some very important target. So for the diagonals, now how I would do the exact same strategy with diagonal. So with diagonals, I would actually buy March put like we should, and most likely it would be 690 or 680, but yeah, it would be somewhere here. So we are buying something good that is actually worth the money, and that gives us a chance to make money. And then I would sell first January put at the lower strike. I explained why with diagonals it's very important to do lower strike. Otherwise, you will just basically start trading volatility, which is not what we do here. But if you sold 680, just to change examples, if you bought 680 for March expiration, you can buy 660, or you can sell 660 or 670 for January expiration. But what I wanted to say that usually with individual stocks, when it comes to diagonals, I care about catalyst. If I have a big target, so let's say we bought at the second downside target stock some Meta because Meta example was good, or at the yearly pivot we bought Meta, for example, and we want to do diagonal instead. Uh, I would think when are the next earnings? Because of course we can't know when Zuckerberg or Trump says something unpredicted, but we have something that we know. So when are earnings? Because if I expect a big bounce, I need some catalyst. So I will make sure that the option that I buy, so that longer term one option will expire after the catalyst. Usually. Not too far from the catalyst. So if let's say earnings are in February 16, maybe 1 week after, because you wanted to participate in that. So catalysts are very important. So my expiration price for diagonal expiration date will always be okay when this stock is about to have earnings report. When Apple will have new scheduled event to present new MacBooks or something like that, but something you know. And then, of course, the ones that you sell, it's also very important. You need to sell the ones that expire before the catalyst. Because also in equities, there is this earnings grind phenomena. There are even scientific papers about that, that, stocks tend to climb like 2 weeks before earnings, something like that. So if that happens, you can, take your money quickly. You will get assigned. You will close all the position, and everything will be fine before earnings, and you already made some money. And if that doesn't happen, like we talked, your option you sold expired. Now you have options. Maybe you want to, if you had January, maybe you want to sell February, or maybe you just want to keep that March option. So it's amazing. It's amazing in a way that this way you will start to think about efficiency and how can I get the same uh, payoff that I want? How can I express my position but without taking unlimited risk, without freezing a lot of capital in my account, because people don't think about that when you have a, let's say, vertical spread, you have maybe $1,000 allocated instead of 40,000. Your other 39,000 can be in a money market fund, and you have still have same exposure. Um, so what I was saying, that catalyst for diagonal is very important, especially when we are trading individual equities. The one that you buy, the longer term option, it would be great if it expired after catalyst. The ones you sell need to expire before catalyst. And with diagonals, you have plenty of different scenarios that market can do, and you still make money. And basically you will get out of 3 4 scenarios, one is of course loss, and all others, some are decent profit and others are unlimited profit. But when it comes to ranges, it's a very important question, because of course my fractal range is first of all about the range, and range helps people to avoid buying or selling a stock in the wrong spot, even if targets align. So ranges should give you conviction in your idea and in whatever that is you want to do. But markets move from level to level, and these levels are what we have, of course, targets, pivots, and macro zones. Of course, macro zones for futures. They are important for everything, but they are derived from futures only. But of course, I wanted to make this video because people ask, how I execute this target. You said right or right out. You said if it closes below, you need to get out. But how to know market is chopping up? So vertical spread or diagonal. At first, I was thinking the first video related to options needs to be about diagonal, because diagonal is, let's call it, not very simple strategy, but it's great. It's great, and it actually, when you understand what you're doing, it helps you get that put option you always wanted for less money.
Very good. I don't see any other question. Yeah, you mentioned that you were going to talk about some idea about how to delay taxes for a year. And
Oh, yeah.
no other
Very good.
question. I mean, maybe you can go to that.
Yes, very good. Very good. We will talk about color, because the strategy that is called collar. It's being used a lot, both in hedge funds space and high net worth individuals, and not only high net worth, because it's just makes sense, and to reduce your tax bill or to delay your tax bill for a year without actually taking some losses or something. So for that, of course, you need to have unrealized gains. So this is, of course, important. So now let's say you have SPY. You have a SPY, and you bought it at the lows, almost at the lows in April, 500. And now you think that, like we were talking, that you think that this move is over and you would like to sell. You would like to sell, but now it's December, and there will be a lot of taxes to pay if you do. So what you can do is create a so-called collar. So now, if we have a SPY, which is trading at 680, and you say, oh, no, that's it. I want to lock that price, but I don't want to sell. So what do you do? First thing is that you sell a call option. And now everyone will say, oh, wait, you said not to sell options. Yeah, you already have that underlying, and you want to sell that stock anyway. So you sell call option, let's say at that same price, 690 or 680, because you think that's it, done. Now what happens? And you sell the expiration, which expires next year. No need to do very long, but I mean, if your tax year is from January to January, like here, for example. So So just next year, so expiring in January, you sell a call. Now what happens? You receive money for it. Now what do you do? Is it yours money? No, that's not what we want to do. We want to uh, eliminate any risk and just to delay the sale of SPY stock. So we use the money that we collected from selling a call to buy a put. And usually, because of put call parity, you can buy the same strike. So, now, simple example: you have SPY, you bought it at 500, you want to sell it here. Uh, you sell a call expiring next year, you buy a put expiring next year, and now doesn't matter because even if market collapses, you locked your profit. I mean, your profit will not change because if market collapses, put starts printing money, so offsetting those losses. If market goes up, again, you wanted to sell, you just wanted to delay to the next year, so it shouldn't matter for you because you wanted to sell. So and they do it all the time. Some funds even do that because they need to report and they don't want others to know that they sold the stock, for example. And again, everything is legal. It's fine. They do the same. I mean, they own that stock, but they create a collar. So technically, they are not lying because they are still owning the stock. But practically, they sold it because that's it. They locked the profit. Of course, they will sell it. mm, Next year or next quarter or whatever they want to do. But this is a color. Basically, for that you need a unrealized profit, and for that you need to sell a call and use that money to finance a put expiring sometime where you actually want to sell it. So I hope it helps.
Yes. So if you guys have any question, that's the time. You can write in the comment section of the YouTube chat.
Yeah. And that's the beauty of options. That's why I think that everyone should learn and understand them, and don't think about deltas, gammas, thetas, vegas, and other stuff because I'm sure those who will watch your recordings will ask, "Oh, at what implied volatility you are buying, or at what delta you are buying." In this case, we are buying at, let's call it 50 delta, just because we are buying where the market is. That's the thing, and the beauty is, like I said, you can love profits, you can give yourself time, freeze the position, avoid selling, limit your risk, buy a different option for less just by selling another option and so on. And then you start playing with this day of diagrams, it will become easier and easier.
Yeah, I think the take from this video is how to finance a position with basically less money. You can have to
For
put that much
for
money and
diagonals,
second
you can, yeah. For
and
diagonals, you can think like this. For verticals, it's just how to express the exact same view you wanted to express, but without deploying a lot of capital to buy that underlying.
yeah, and second, yeah, it's to manage your risk
Of
because
course.
you've shown the calls and puts, and you can actually see the losses
Yes,
incurred.
exactly. Exactly. And
So
then you will not be afraid of a chop in the market, and gap up, gap down doesn't matter. You already know all your scenarios, worst scenario, best scenario, you know what to do. And in both these strategies, actually, that 50% loss limit um, is not too often that it happens, and actually it helps to supercharge your P&Ls even more because on a losing side, your losses will be actually not the price of an option, but actually only half of it. So of course you will start losing. because what I wanted to stress is that when I say, oh, the maximum loss is 400, the maximum gain is 1200, don't wait for that maximum loss of 400 to happen. If you see that it's not working, it's not working. Yeah.
Yeah, Fitzroy asked if you are if you would be willing to do a live session trading options using MFR tools. I basically did it right now.
The only difference is that, yeah, of course, live prices, you can see different scenarios what you do. So, yeah, of course, why not? One day, why not on a paper account with a live options data, we can do practical examples. I think, I don't know when, but I think it's viable.
Okay.
Why not? We will take a live option chain, we will choose a stock which is next to the target, and then we will compare different strategies to see what makes sense to do.
Okay, that was it. I mean, I
Yeah,
would encourage everybody to rewatch the video. It's gonna be available in the trading plan section anyway. You just click on the YouTube video there, and it's gonna show this recording. So yeah, rewatch it, take notes, and yeah, manage your risk using what Vi described. That's it, Vi.
yeah.
I think
So
we can wrap it up.
yeah, so thanks everyone. Happy holidays. Manage your risk, and on Sunday there will be a very important video because, of course, we will have new macro zones for a lot of important assets. So watch that as well. Bye.
Bye.